Hi, everyone. I'm Jessica Morin. I'm head of U.S. Occupier Research, and I'm also joined by Joe Biasi, our head of U.S. Capital Markets Research. So together, we're going to guide the conversation through the various sectors for the remainder of today's call, and we're going to be joined by our U.S. sector leads who are going to be sharing the current state of the market, their 2026 outlook, and then we'll also have a discussion on what trends are driving these sectors in 2026 and beyond. So with that, let's go ahead and get started. I'm going to have our industrial and retail team join us. This is going to be Lisa DeKnight and Brandon Eisner. Lisa, can you just give us a quick state of the market on industrial?
Sure. Thanks, Jess. Hello, everyone. Where we stand here in January, industrial momentum is building. We are coming out of the fourth quarter with the highest quarterly absorption we've seen in 2 years, with the expectation that overall activity is going to be stronger this year than last. Why is that? I'll share a few reasons. One, there's a lot of space rolling in the next 24 to 36 months, and many companies in that tenancy block are going to look to upgrade into new facilities to optimize their network. And this year is really the moment to strike, because while I expect vacancy to stabilize, it will still be historically elevated. Therefore, rents are going to stay pretty flat before starting to show, I'd say, more meaningful growth across the board in 2027. Also, and I think Brandon will probably have something to say about this too, from the consumer and corporate side, we are expecting a boost in spending due to fiscal stimulus via tax refunds and incentives from the One Big Beautiful Bill. And I also say another reason why I think 26 will be better is this is building on trends we observed in 25 as well. There are specific sectors in growth mode, boosted by the AI CapEx super cycle that we're in, as David mentioned at the top, such as advanced manufacturing and data center related requirements. I would say these are more of a market specific conversation, but together it's large enough that it will really tip the demand scale nationally. Now, I would say keep in mind that while I am taking an optimistic outlook on the industrial market, the pre-2020 average annual baseline for both supply and demand was around 250 million square feet. And for 2026, I'm expecting around 180 million square feet of net absorption and 220 million square feet of new deliveries. I will say that supply addition will be the lowest in nearly a decade, but we still have some catch up to do on the demand side. This year, however, will get us closer to that state of equilibrium. And Brandon, I'll pass the mic to you now.
Sure. Thank you very much, Lisa. So I will say that the beginning of 2025 was a bit scary. We in retail, there were mass closures of retailers hitting the market. Joann, Party City, Forever 21, Rite Aid, seemingly all at the same time. And adding to that a lot of retailers are downsizing their overall footprints. They're cutting underperforming stores, mainly just to gain efficiency within their operations. So that can be a good thing, but it was a drag on. It can be a drag on retail occupancy overall. That led to 2 quarters to start 2025 of significantly negative absorption. However, as I've pointed out many times, retail market deliveries have been very low, going all the way back to the GFC. And these low deliveries, they've acted as sort of like a wall. It's a wall that's been made of not building things. But this wall it's kind of defended the retail real estate market against any harsh conditions that it's faced, such as struggling retailers and overall economic uncertainty. So, to put that into numbers, over the last 15 years, the retail real estate market has retail occupiers have absorbed 105% of the new space that's been delivered. So that equals a solid supply and demand balance. And this has strengthened the resilience of retail. It's allowed fundamentals to remain strong despite being surrounded by these uncertain economic times. The good news is that in Q3 and Q4, the market recorded positive absorption, significantly positive absorption in Q4. Many owners and investors of retail real estate feel that the worst of the retail closures are behind us. So I'm cautiously optimistic about 2026.
Thanks, Brandon and Lisa. I think it's interesting that both of you know the huge drop in new supply, right? And that's definitely going to help stabilize your sectors or even set it up for a turnaround. But I also think it's interesting too that David mentioned a lot of mixed economic signals and still uncertainty in the market. So can you tell us both a little bit more about what is driving both of your optimisms in the sector? Lisa, let's start with you.
Yeah, just the sheer volume of lease events that we see coming down the pike, I think it necessitates decision making. And one thing that contributed to a lot of delayed decision making last year was Liberation Day, of course. And I am cautiously optimistic that we're not going to have another major event like that throws everyone into uncertain territory this year. We're really looking at incremental improvements and clarity on the trade front, possibly even surprising to the upside pending the Supreme Court decision on tariffs. But fundamentally, we are past the worst of the uncertainty phase, which was 2Q of 2025. So I expect some sectors that have been on the sidelines for a while, like consumer goods occupiers in particular, they'll feel more confidence about coming out to the market to leverage favorable conditions and secure new modern space that's going to position them to be more efficient and cost effective through their real estate. Also, just to dive a little deeper on another reason I gave earlier, the market is just starting to catch up to the nearly $750 billion in manufacturing investment that was made over the past 5 years. And as major projects deliver and go into production, it's really lifting economic and industrial prospects in markets across the country. Compound that with all of the industrial leasing requirements that come from building AI infrastructure, plus the continuing tailwind of e-commerce, and you have an industrial demand growth story to be optimistic about.
So, following that on the retail side, I would agree with a lot of that. And then there's no question that there's uncertainty about tariffs remaining. And to date, retailers have a lot of them have shown resiliency within this period. They've shown a lot of agility. This is agility that they've been building, since back around the GFC when they had to deal with the rise of e-commerce, and then obviously that we saw throughout the pandemic. So the tariff issue, it's largely been navigated by a mixture of actions, including switching countries that they import from to making better deals with their suppliers and distributors, and some of those costs have been passed on to consumers, but some of the retailers have eaten those costs in order to keep customers and maybe win customers from other retailers. And so I've kind of called this a kind of a chaotic ballet that is going on within retail, and which has helped minimize the effects of tariffs. But again, that does, in 2026 we're going to have to continue watching that. Another thing that looks good for retail is that a lot of the younger generations, especially Gen Z, it turns out that they have a lot more spending power than was originally thought, which they're starting to take advantage of. We touched on this on our recent report called Luxury Retail Meet Gen Z. And so when you look at retailers, expanding retailers, they're going to look at the markets where higher concentration of Gen Z are living or moving to. These are some positive notes for the retail industry going into 2026.
All right, so you both used the phrase cautiously optimistic. So I'm going to take the other side there. Why cautiously? But what are some of the things that kind of interrupt that optimism to some degree for 2026?
I can start on that. There's obviously concern about how much more consumers can spend. They've already been pressured so much by inflation that's just stubborn and it refuses to go away. A good example of this is the restaurant industry, where foot traffic, it continues to be solid. According to OpenTable data, in December, foot traffic in restaurants is up 8% year over year. But there's been a lot of narrative that people aren't going as all out at the restaurants as they used to. They still want that experience of going out to eat, but they might split an appetizer. They might have one less drink. They might split a dessert. And on top of that, there's there's other examples of people responding well to discounting or other incentives, which is great, but it can affect the bottom line of retailers. And then one other thing that I've been looking at is that a lot of people are even trading down to resale or secondhand retail when they can't find what they want at the price that they want. One thing that I've been noticing is miscellaneous retail. That category, that's the one that contains resale or a thrift retailers. That was up 16% in November year over year, which is a gargantuan amount. And so when you look at that, that could kind of spell some trouble, right, for some retailers such as discount retailers or mid-market retailers, especially on the apparel side. So that's just a look at some things that could potentially upend the market a little bit.
And I'll chime in here to kind of double click on something that Brandon alluded to earlier, but corporate bankruptcy and restructuring that dragged on industrial net absorption last year too. Those same retailers, they have warehouse space. Last year was actually the highest volume of corporate bankruptcies in 15 years. Financing conditions, I think they're better now than last year, but it's likely that corporate bankruptcy risk stays elevated. And so there will still be some occupancy loss from tenant credit loss. Also, because conditions are better, there's going to be more of a deregulatory environment under this administration. I think it's likely that there's growth in corporate deal flow this year as well, with M&A and private equity influencing real estate footprints. Sometimes these sorts of deals can drive new industrial requirements, but often they involve consolidations. That can also be good for capital markets activity. But certainly, I think expansions and growth far outweigh any occupancy losses. But those are some of the reasons contributing to why I am forecasting annual absorption that is still below that pre-2020 baseline, even though it's a marked improvement from 2025.
All right, so quickly, because we're about to wrap up the section, but I did want to ask about bifurcation in both of your sectors, right? I think retail and industrial have really interesting kind of quality bifurcations. Retail is the only asset class that I said I thought was going to have cap rates compress, and that has a lot to do with the high quality stuff. So in like 30 seconds, can you talk to me about how your markets, I know it's hard, are experiencing market bifurcation and the strengths and weaknesses that adds?
One thing I've noticed a lot is that newer buildings are absolutely sought out more than older buildings are. And of all retail space on the market, about half of it has been on the market for 24 months or longer. That's suggesting that subprime space is just remaining on the market, and it's probably will lag on the market, and that percentage might even continue to go up as retailers become more choosy about their space, and that will translate into the better assets being more occupied and having the better fundamentals.
And I will definitely agree with Brandon. Newer space is entirely driving net absorption in the industrial market, but I'll also say look to the bookends of the industrial inventory, and I'm talking about small bay and mega box. Both are outperforming. Small bay has the tightest vacancy of any size segment by far, and then mega box is where developers really hit the brakes hardest and fastest, and demand has really come back. Vacancy has already peaked in that 700,000 square foot plus segment. It's coming down, and the pipeline for that mega box space is nearly 80% pre-committed. So I'd say look to the bookends, and cannot understate how much new product is driving demand right now too.